Good morning.
Good morning.
Good morning. Like 5 minutes ago, my granddaughter was born.
Congratulations.
Congratulations.
Oh, thank you. She's the one that's in Los Angeles with COVID, and she had to be hospitalized yesterday because she was starting to have liver issues. So they induced, and she's been laboring all night since yesterday afternoon. She was just born 5 minutes ago. How in the world you labor on Pitocin and with pneumonia, I don't know. But my granddaughter's born. She's fine. Oh, I mean, literally just got the news. But we've got counting to do. Wait, where'd she go? Here. My granddaughter.
Oh, so cute.
Thanks. So anyway, all right. So we do have a lot to focus on today with finishing chapter 10. I'm sorry, I've been up all night worrying because of that. But anyway, I'm here. Yay, her name is Sadie. What we're going to cover today is the on the note page that I had, given to y'all last week. There was the second part. We talked about what costs have to be capitalized. Excuse me. What costs have to be capitalized? What costs have to be capitalized for tangible assets, intangible assets, and natural resources. How are y'all doing with that? Were you able to work problems with that okay? With calculating the ARO, the asset retirement obligation? Okay. I believe I'm caught up on grading. I did spend all day Friday finishing up. So I know that there were some, I think primarily in the 10 o'clock class, that there were some issues with uploading with the virus. I'd never heard of that before, but did just go back and make sure that your AS1 and your data analytics 5 are graded. Some students had to email it to me. So I want to make sure that I caught all of the ones that have to be, that were emailed, because I have so many emails. So just make sure that your AS1 and your data analytics 5 is graded. If not, please, send me an email. So the next part that we were going to take a look at were the way, I didn't give y'all time to answer that question. How are you with the capitalization part of those three types of long-term assets? The costs that have to be capitalized for tangible, intangible, and natural resources.
I'm fine with it.
Okay. All right. So on the second page of the handout that I had word processed for you are the different ways that we can finance long-term assets. So I'd like to go over each one of those, particularly the ones where we're going to have to do number crunching, where we've got, where we have non-interest bearing notes. Non-interest bearing notes, did we cover any of these when we went through time value of money? I didn't think so, okay, because my principal's class has, and so anyway. All right, so what non-interest bearing notes are, The name of it is misleading in the sense that it makes you think that they don't have interest. They do. Anytime that we borrow or loan money, over a length of time, we learned in time value of money that there is interest. I mean, just because of the time value of money. So the non-interest bearing notes are notes that don't have a stated rate. I often give the example in class that you've ever seen the advertisement where for cars and they'll say, come on, we've got this great sale going on and you can finance your car for 0% interest. Well, do you really believe that there's going to, for 5 years, do you really believe that you're going to be able to finance a car for 5 years with no interest? No. I mean, time value of money, business concepts tell us that we are going to have, that there's going to be interest. And so what happens is that they'll say there's a 0% stated rate, which is where the non-interest bearing comes from. But what do you think the car company, the dealerships do in order to compensate for this quote unquote non-interest bearing? Are they going to get their interest one way or the other?
Yeah.
Yes. So what would they do?
They build it into the price, no?
Exactly. They would just bill it into the selling price. They would just bill it into the selling price. So on page, in the textbook, on page 527, I'm sorry, I've got it written down on these page notes. I don't know why I don't use them. Oh my God, I just have another grandbaby and she's healthy through all this. Now I don't know how Maria's doing with her liver and all, but okay, so the non-interest bearing notes, what we need to do is we need to figure out how much interest is implied in the note. Okay, so although it says that there is a 0% interest rate, the interest is implied in the note itself. Okay, the present value of everything the company gets is the amount that you paid for the car. Okay, the present value of everything that you got. So when you were reading page 527 and you were going through the example that they gave you, you saw that there was an account. I'm sorry, I've got just so much going on in emotion, both from just tremendous relief, is the discount on notes payable. The discount on notes payable. And when you went through the problem with Midwestern Steam Gas Company, illustration 1010, and you saw the account discount on notes payable, one, what type of account is it? What kind of an account is discount on notes payable? But does it have a debit balance? Look at the journal entry on page 527. Good. So what kind of does it have a debit or credit?
Debit.
A debit. Okay. And it's related to what account? Discount on notes payable. So what account is it related to?
Interest expense.
Our
Notes payable.
good, Tanisha, notes payable. Okay, this is a discount on notes payable. So the discount on notes payable is a contra liability account. It has a debit balance and it is a contra liability account. It is linked, as we know that all of our contra accounts are, they're linked to another account. So we know that this discount on notes payable is linked to the notes payable account. Okay. So the notes payable account is a credit. Obviously, a liability has a credit. And we subtract from it the discount on notes payable, and that equals the carrying value of the note. So we will have, let me get some lights going on here. You will have notes payable, and I know my shadow is on this. So you will have discount on notes payable, and we will subtract the contra liability account, discount on notes payable, and the difference between the two is called the carrying value of the note. The carrying value of the note is what is reported on the balance sheet, but it is also used to calculate interest expense. Okay, so the notes payable account that is created is credited when we first get the note. You can see on page 527 that notes payable is credited for the face value of the note. Okay, so looking at page 527, you can see that notes payable is credited for the face value of the note. Of course, the amount of cash that you get, or in this case, they purchased equipment, and so the bank sent the money that the company borrowed directly to the company that they borrowed the equipment from. If you get the cash and then pay the cash to pay for the equipment, then you would debit cash, debit discount on notes payable, credit notes payable, and then you would have another journal entry where you're debiting equipment and crediting cash for the amount that you paid for the equipment, okay? So this notes payable is credited for the face value. You're going to see that we have to calculate the present value of the note because of the time value of the money. The difference, the discount on notes payable is debited for, and I know I'm squinching this up, but is debited for the difference between the present value and the face value. Okay, so notes payable is credited for the face value of the note. The contra liability account, discount on notes payable, is debited for the difference between the present value of the note and the face value of the note. That the amount of the discount, the amount that is the difference between the face value and the present value, which is the amount going into the discount on notes payable account, is going to become interest expense over the life of the note. It's going to become interest expense over the life of the note. And you can see the calculations and the journal entries on the bottom of page 527. Okay. So let's take a look at exercise 10.9, which is on page 554. So let's get your calculators out, your BA2 plus. And let's take a look at exercise 10.9. Exercise 10.9. I would like to give you a few minutes to work it on your own to see, one, you know how to calculate time value of money. So use the information and calculate what the present value of the note is. And then do the journal entry to record the purchase of the tractor. After you do that, requirement number 2 and requirement number 3 will do together. Liam, how are you doing this morning?
Good, how are you?
I'm doing good. It's been an interesting evening and morning, but the end result was great with the granddaughter. And of course, I can't imagine what they've been going through, but so doing pretty good. Ashley, how are you?
I'm doing pretty good.
Good. Ryan, I hate not seeing y'all's faces. I miss y'all terribly. I don't know. Daniel,
I'm doing good, how are you?
are you doing good? Good. So you know where to start on this with calculating the present value?
Yeah.
Okay, cool. And Ryan? Ryan?
I'm doing good.
Good. Okay, because I just want to make sure, since I don't see your faces, that you're doing okay. And Afia? Afia?
Yeah, I'm doing good.
Okay, good. I just want to make sure. I think I've called. Oh, Miss Pham. How are you doing?
I'm doing okay.
All right, good. So I'm going to go ahead and start doing this in Excel so we can show how we calculate the amount of interest that will be paid every year. Go ahead and do the journal entry. I assume I mentioned that. Congratulations, Grumpy. Oh, I know. I know my students are working on a problem, so congratulations, Grandpa. Oh, she's beautiful. I know, I'm so excited and yay. And there is creamer in there if you don't mind making some coffee. That's stuff. Thank you, dear.
Just give me a little bit of time.
I will. All right, so what did we get as the I haven't calculated yet. My husband came in, first time I've seen him since he's my husband goes by Grumpy as his grandfather name. He's a funny man. All right, so let's see, we had an interest rate of 10%. It was a 3-year note. And the amount that they were going to pay at the end of the 3 years, which is your future value, was $25,000. And then we calculate the present value. Okay, so I know y'all didn't know I was away from y'all, but I was working in Excel. So what did we calculate as one? What was the present value of the note? What did you calculate as the present value of the note?
18,782.87.
Okay, good. Okay, did everybody get that okay? I think time value of money we're doing good in. Did you have a question? All right. Now, what would be the amount that we would capitalize the tractor for? What would be the amount that we would capitalize the tractor for?
23,782.87.
Wonderful, Ashley. How did you get that number?
I added the 5,000 to the present value.
Exactly. Good job. Remember, you've got to calculate the amount that's capitalized is the present value of everything that you got, of everything that you paid. I'm sorry, I was thinking of everything that you got, thinking about our revenue recognition. But the amount that would be capitalized is the present value of all of your acquisition cost. We paid the $5,000. Naturally, the present value of the $5,000 is $5,000. And so let's go ahead and I'm going to start sharing my screen with you. Do y'all see my screen? And I will. And so our journal entry would be, how much would I debit the tractor for? And again, Ashley gave us this amount. I am not going to round here. although you know in Connect when it says to round, but because we're going to be calculating the interest for each of the 3 years, I didn't want to get into rounding issues. So the amount that we would debit the tractor for, as Ashley told us, is the $23,782.87, the present value of the note plus the $5,000. Thank you so much. Now, of course, we're going to credit cash for $5,000 because that's the amount of cash that we paid. And how much would we credit the notes payable for?
25,000.
Good. I think that was Nicole. 25,000. You're going to credit the notes payable for the face value of the note, for the face value of the note. Now, obviously, our journal entry is not balancing. So the amount of the discount is the difference between your present value of your note and your future value of the note. That is the amount of implied interest that is in the note. The amount of the implied interest that is in the note. So the difference between the face value of the note and the present value of the note is the amount of my discount. Oh, I'm going to get this straight in just a minute. And now our journal entry, of course, should balance, okay? So the capitalized cost of the tractor, the amount that's going to be depreciated over its useful life, will be the $23,782, and the $6,217.13 is the amount of interest that we will recognize in each of the 3 years. Now, when did I purchase this equipment? When did I purchase the tractor?
January 1st.
Okay, good. On January 1st. So we know that, you know, the principal times rate times time, that our time is going to be 12 over 12, because the note was outstanding for the entire year. So let's take a look at how much we would capitalize, how much interest we would recognize each year from the non-interest bearing note. So we purchased it on January 1st of 2021. And my carrying value on that date, remember, how do we define carrying value? That was what I had up here, kind of squinched up a little bit. How do we define carrying value?
Payable.
Good. Notes payable.
Subtract the discount on the
Very good, Ms. Pham. Subtract the discount. So the carrying value of the note is the notes payable minus that contra liability account, the discount on notes payable. So the carrying value on January 1st is equal to the present value. Now that's the only time that it will. Oh. So the carrying value on the first day, on the first year, is equal to the present value of the note. That is the only time that that will happen. And interest expense is the carrying value times rate times time. So on December 31st of 2021, is going to be equal to the carrying value times the rate, which was 10%, times time. It was on January 1st, so our times time is times 1. So the amount of interest that would be recognized on December 31st of 2021 would be 1878.29. Now on the problem, I couldn't remember if they pay interest every month or they're just paying it at the end of the 3 years. Yeah, principal and interest are both due on December 31st of 2023. So what journal entry would we do? What journal entry would we do on December 31st of 2021? Well, what did we incur?
Interest expense.
Okay, we would debit, I'm sorry, I was talking over you. Sorry, Nicole.
Debit interest expense.
Okay, good. We will debit interest expense. And what account are we going to credit?
Discount on notes payable.
Very good. The discount on notes payable. What would we credit if it was a regular interest-bearing note? If this was a regular interest-bearing note, what do we credit when we accrue interest?
Interest payable.
Good, interest payable. But here, the customer, us, because we bought the tractor, we're not going to be paying interest. At the end of the 3 years, we're just going to pay the $25,000, of which they called non-interest bearing, but we know that there is implied interest within the $25,000. So I would debit interest expense and credit the discount on notes payable for the 1878.29. Now, what would be my new carrying value? Would it be higher than the 18,782 or lower than the 18,782?
Lower.
Lower? What did we do to the discount on notes payable account? Taylor, what did we do on the discount on notes payable account? Did we debit it or credit it?
Credit it.
Good. What happens to a liability when we credit it? Does it increase or decrease?
Increase.
Good, it increases. So the carrying value of this note increased because we credited the discount on notes payable, okay? So our new carrying value is going to be equal to the old carrying value plus the amount that we credited to the discount account. Now, because I used good Excel techniques, well, before I do this, go ahead and calculate what would be interest expense for the year 2022. What would be interest expense for the year 2022? Don't let me use my Excel magic. Have you ever just wanted to have tears of relief? Not only joy, but just relief, because with her liver issues, can you imagine laboring with pneumonia? It just blows my mind. But anyway, I'm so relieved. Okay, back focusing on this. So what would be the interest expense for the year 2022?
2,066.12.
Nice job. Nice job. It would be my carrying value, which has changed because I credited the discount on notes payable. So it's going to be my carrying value times my interest rate, and I anchored my interest rate because I, don't want it to copy relatively. And so copy these down to the 2, and we get interest expense. You can see the numbers of 2022 for 2022 and 2272. Now, if I were to sum up the interest expense, what number would it equal?
6,270. The discount on the notes payable.
Very good, Catone. The discount on the notes payable. Because remember, the discount on notes payable is the amount that's going to become interest expense over the life of the note. Is it a surprise that the carrying value of the note ended up equaling the face value of the note? No. Okay. So for December 31st, 2022, I would debit interest expense and credit the discount on the notes payable for the 2066. And then for December of 23, I would debit interest expense and credit the discount on notes payable for 227273. What is the balance? So we know that the face value is equal to the 25,000 at the end of December 31st, 2023. What would be the balance in my discount on notes payable? At the end of December 31st, 2023, what would be the balance of my discount on notes payable?
0.
0, good. Because what did we credit it for when we, what did we debit it for when we purchased the tractor? The 621713, which is the difference between the present value and the future value. And then each year I credited it. Remember, it was a debit. It was a discount on notes payable. Then each year I credited it, of which Catone told us added up to the discount amount. So if it had a debit of 621713 initially, and then each year I credited it for these 3 amounts, then the ending balance would be 0. And then on December 31st, 2023, when I paid the note, what would my journal entry be? So how much am I paying? How much am I writing a check for?
25,000.
Good, 25,000. So I know I've got to credit cash for $25,000. And what would I debit?
Notes payable.
Good, notes payable. And then my notes payable account now has a zero balance. We had credited it for $25,000. Now we're debiting it for $25,000. Its related discount on notes payable account also now has a zero balance because we had debited it for the initial amount, and then we credited it for these three individual amounts each of the 3 years. So it has a zero balance. Okay, so this is the accounting for when we have non-interest bearing notes. We know that there is implied interest in the note, and the amount of the implied interest is the difference between the present value of the note and the face value of the note. Okay? All right, so let's go back to, I'm going to stop sharing my screen. I think I am. Was I sharing? Oh, never mind. Okay, here we go. So one of the ways that we can finance long-term receivables are through these non-interest bearing notes. Let's begin. Do you see the ways to finance long-term assets on the sheet that I gave you? All right. So if we pay cash, that's easy. Debit the asset, credit cash. If it is a regular interest-bearing note, then we know and I'd say debit cash and credit note payable. Often when you go into buy a car, the bank isn't that you're borrowing money for to borrow the bank, to borrow money for the car is not going to give you the check and then you write a check to the dealership. What's going to happen is the bank is just going to send the money to the dealership. Okay. So when we pay with cash, we would debit, say it's a tractor, we would debit tractor and credit cash. On an interest-bearing note, we would debit the tractor and credit the note payable for the face amount of the note. Now, when we accrue interest, just to make sure that you haven't forgotten, when we accrue interest every year, say they're just going to pay the interest at the end of the term of the note. In this case, it was 3 years. What account would they credit every year to accrue interest expense on a regular interest-bearing note? Come on, basic accounting. What would we do?
Credit note payable.
Very good, Ms. Pham. We would credit the notes, not the note payable. We would credit interest payable. Good. We would credit interest payable, just like we have learned. Now the third one, the non-interest bearing note, we just reviewed. And then I have on there the bullet points of what I had talked about on the blackboard and in the in discussion. Exchanges we will talk about when we get into chapter 11 and we start just talking about how we dispose of long-term assets. We can sell them, we can retire them, we can exchange them. So we will deal with exchanges in chapter 11. What you need to remember in reading chapter 10, and we'll go over it, but please make sure that you have read it and understand it so that we can efficiently go through, is what is the difference between an exchange with commercial substance and without commercial substance? And what is commercial substance? The second way is that we can issue equity. And you often see this when companies are starting off. You think of an entrepreneur that's starting off a new business. Well, you may have an investor that is willing to invest in your business, but instead of giving you cash, they give you a long-term asset. Say, for example, that you need a warehouse, you need a place to build whatever it is that you're going to build. So they're donating, and I say donating, they're getting an equity position in the company where they give you a building and land in exchange for equity in the company, common stock in the company that you've got now an ownership position in the company. At what amount would we debit equipment and credit common stock for? I've got it written on the notes. I summarized it all for you in the notes. We got sleepy heads this morning. Katone, where's your coffee?
No, it was just a bad weekend.
A bad weekend, huh?
It wasn't my weekend.
Oh, were you sick or
No, I'm healthy.
healthy? Good. Okay.
That's not it. Yeah.
Yeah.
Me and Lauren broke up.
No, you did not. Okay, we'll talk about that later. I happen to know Katone's girlfriend because I taught her in principles, and I'm sorry.
No, it's okay.
We'll talk about that another time. See, I told y'all I get to know y'all if y'all let me, and I can support in many ways. All right, so when we issue equity, what amount would I debit the long-term asset for and credit common stock for?
The fair value?
Very good. The fair value of what? The equity or the asset?
Assets.
Well, it's equity, but it's equity unless we don't have, not all stocks. Look, there are many privately held companies out there, and I can't go to the Wall Street Journal and look up what the fair value of that equity is. So if the fair value of the equity is not determinable, then what would I credit common stock for and debit the equity for, Katone? You had said it.
The assets received.
Good, the fair value of the asset received. So it would be the fair value of the equity if determinable. If not, just use the fair value of the asset itself, of which they should be the same, right? Somebody, whatever the fair value of the asset that you're giving should equal the fair value of the equity position that you were given. Another way that we can acquire long-term assets is that they're donated to us, You don't get any equity position in the company at all. The assets are just donated to you. So what would we debit the asset for and then credit the amount of the donation for? So say they donated long-term asset. What would I debit that asset for? And then what would be the corresponding credit?
The fair value, and then you credit revenue.
Very good. Nice job, Nicole. You would debit the asset at the fair value of the asset that you received. GAAP says that when we have donated assets, that it is a revenue, that it would be recognized as a revenue. Now, who is going to donate assets to a company? Where do we typically see this happening? Did they look on page, at the bottom of page 528, but then it goes to page 529. And what did you read as an example of when we see donated assets? Is everything okay? Marie is okay? Thank you. So Sadie, we have a new granddaughter. Can you top that?
What? Get more coffee?
A little bit of more cream, but definitely more coffee. So to hurry this up, because we've got capitalized interest to do, the donated assets that you see are typically with governmental entities. That you think of a state or a city or a county that's trying to encourage companies to build in their city. There are a lot of benefits to it with employment, the employee. I mean, you can imagine the benefits that are having. I know it's been a couple of, maybe a year ago now, when Amazon was going to build their corporate headquarters in New York City, and we had a political person that didn't take care of that, and for a lot of reasons they pulled out of it, and so New York City didn't get Amazon. And I don't know what that deal was, but when governmental entities are trying to attract new businesses, say they've got some land that they own that's not being used, it's not conducive to building a park, and they have this land, and they'll say, look, we will donate you land if you will build here. Okay, so that is often where you see it, is donated assets, or when companies are, where governmental entities are trying to entice companies to invest in their location. And the governmental entity would then donate assets in order to encourage that. So that's where you see it, and what you read about, you know, with incentives from governmental units. That's what they're referring to. Right, so those are the ways that we can finance long-term assets. Now let's go ahead and take on capitalized interest. I hope that you spent some time, as I asked you to, working problems on capitalized interest. We're going to do a lot of number crunching today on capitalized interest. But what is the concept? First of all, when do we capitalize interest? And this begins on page self-constructed assets begins on page 535 and 536, where they had the discussion of it. And then, of course, 537, 538, 539, you critically read the calculations. And that's where I have the decision tree for you. Did you see the decision tree that I uploaded? I used to write this decision tree on the board as we were going through it, and I know it wasn't going to be possible, so I reached out to Professor Goodwin and said, can you put this in Visio for me? And he did, because he's teaching the intermediate class at night. So you got a pretty picture of it, the decision tree. So when do we capitalize? When do we have to take into consideration that we have to capitalize interest? Ryan, when do we have to capitalize interest? Well, what is the name of Part C? self-constructed assets. Man, y'all are on fire this morning. Thank you. Y'all are just impressing me so much this morning. Come on, intermediate students. We got some learning to do between the rest of chapter 9 and all of chapter 11, which doesn't get any easier. Okay, so, all right, do we need to do some jumping jacks to get the blood flowing this morning? All right, so whenever companies, you know, remember that I bought that piece of land and I've decided to construct my own corporate headquarters. So when we self-construct our own assets, remember the cost that is being capitalized is all cost necessary to get the asset ready for its intended use. So all the costs that we're incurring in order to get that asset ready for its intended use. Well, one of the things that, if you look on page 536, one of the things is that usually when companies are going to construct a large asset, that they're going to have to borrow money. They're going to have to borrow money. If they've been saving their money and are going to pay cash for it, what do we do with the interest on the other debt? What do we do with the interest on the other debt that the company has? They defined the qualifying assets that are self-constructed, and we also have the period of capitalization. In which period during the construction do we have to capitalize the interest? And the basic answer to that question is, as soon as we start building it, we've got to take into consideration capitalized interest as part of the cost that we're incurring to get the asset ready for its intended use. And then the capitalization period will end when that asset is substantially ready for its intended use. Yay, it's built and it's ready for us to move in, or whatever the intended use of that asset would be the end of the capitalization period. So during that time period, we've got to take into consideration any interest that would be capitalized. Okay. Now, before we get into number crunching, read the bottom of page 536. Read, and it's called Average Accumulated Expenditures. And there are some italicized words. And remember, when they're italicized, it means that, hey, pay attention to me, pay attention to me. So take a few minutes to read those two paragraphs and highlight, because we need to understand, why is interest considered part of capitalized cost? Why? So it's really in the first paragraph. The second paragraph, talks about what interest is capitalized. But what is the concept behind it? Why do we capitalize interest?
We capitalize the interest when we take on the project, right?
Right, well, right, because we read that the capitalized interest period, the period of capitalization, begins when we first start constructing the asset, and it ends when that asset is ready for its intended use. So it is during that period. So why am I capitalizing interest during that period? Why is it considered a necessary cost? I'll say necessary, a cost. If we're incurring that, why is it considered part of capitalized cost? Why is it considered cost to get the asset ready for its intended use? What does it say? Daniel, what's it saying?
Can you repeat the question one more time real quick?
Yeah, what is the paragraph at the bottom of page 536,
Yeah.
accumulated? What is that paragraph saying? Why are we capitalizing interest? Why is it considered a necessary cost of getting that asset ready for its intended use?
It's necessary to determine the average amount.
Well, we're going to be calculating the weighted average accumulated expenditure in order to calculate it, but why are we having to calculate it? What is the concept behind it?
Are you
What-
saying the actual interest incurred during the capitalization period?
Well,
Is that what you're referring to?
it's not all the interest
Or
that,
only the one that's like actually been incurred or used?
well, we're gonna see in the calculations, not necessarily true, but what are the 4 words that are italicized?
At the way bottom, interest capitalization of interest recognition. Is that what you're talking about?
Right, so it, under that first paragraph of average accumulated expenditures,
Mhm.
what are the 4 words that are capitalized, italicized?
Oh, could have been avoided.
Could have been avoided. Avoidable interest. Avoidable interest is the reason why we have to capitalize interest. Okay? I need everybody awake. Katone, I understand, but I need everybody awake, please. The amount of interest that could have been avoided. In other words, we're going to see that companies could, one, when they start the construction process, as I said in the beginning, they could have to go out and borrow money in order to build the corporate headquarters. Okay? So if they weren't building this asset, then they would have avoided paying interest. They wouldn't have had to borrow money. So they would have avoided paying interest. What if the company had saved cash to build the asset and they weren't going to have to go borrow money specifically? Notice I used the word specifically because we're going to refer to that when they go out and borrow money specifically to build the asset. That's referred to as specific debt. But what if they had saved and they had the cash to build the asset and they had other outstanding long-term debt that the company had incurred, last year, this year, but that they had incurred for other things? So we're going to call that general debt. General debt. So we're going to differentiate between the 2 types of debt that we're going to have to consider for interest capitalization as specific debt. One is the specific debt is they had to go out and borrow money specifically to build the asset. General debt is debt that they already had just from doing what they do, normal operations. But what if they weren't building this asset? They weren't building the corporate headquarters. Then the concept of it is they could have avoided interest because instead of building the corporate headquarters, they could have paid off their debt or paid on their debt. They could have reduced their long-term debt if they were not building this asset. Okay, so the concept of avoidable interest is the concept that is requiring us to look at, is capitalization of interest part of the cost of building an asset? If we could have avoided interest, then the amount of interest that could have been avoided if we weren't building this asset is going to be capitalized. Okay? So now what I want you to do is I want you to pull out, we're going to get into some heavy duty math. So if you need to get a sip of coffee or do jumping jacks to get the blood flowing, stand up and do some stretches. Look at, before we get into the number crunching, look at the decision tree. It's just beautiful. Almost as beautiful as let me look at obviously my son is Caucasian and my daughter-in-law is Filipino. And so we've just, been dying to see what she's going to look like. And she looks like a combination of both. Anyway, I'm just so excited. I'm not going to look anymore. So we've got the concept of capitalized interest. And how do we know what interest we're going to capitalize? It gets complicated. So let's look at the decision tree, because I want to make sure that you understand, before we get into the calculations, I want you to understand the decision tree that we've got to go through for calculating interest. So the very first question is there specific debt? Is there specific debt? Now, what am I referring to when I talk about specific debt? What did we just talk about with specific debt? Liam, what did we talk about as specific debt?
About it could not be avoidable.
Okay, right. Well, we're going to be calculating interest that could be avoidable, but what kind of debt was the specific debt? What did I say that we need to be able to differentiate between specific debt and then other general debt or other debt? What is specific debt?
Oh, I'm not sure.
Okay. What did we-
Specifically to build the asset?
Very good, Taylor. This was the company went out and borrowed money specifically to finance the building of the asset. Okay, Liam?
Yep.
Okay, remember talking about that. So the very first question is there specific debt? Did the company go out and borrow money specifically to fund the building of this long-term asset? Let's go down the easy one first, or easier. Neither one of them are easy. So if there is no specific debt, meaning the company had saved money, they didn't have to go out and borrow money to specifically build the asset. So if there is no specific debt, then the question is there other outstanding debt? In other words, did the company have other LTD, long-term debt? Most companies do. There are very few companies that have zero debt. So is there other outstanding debt? If the answer is yes, then we have to calculate, look at this decision tree because we're going to be using it. So I want to make sure you understand it. So if the answer is yes, then you have to calculate, the WA stands for weighted average. You have to calculate the weighted average interest rate. And then if you want to, right here, insert of the other outstanding debt. We'll just simplify it and call it other debt. So we're going to use the terms specific debt, and then we're going to use the term other debt. Okay, specific debt, as Liam and I talked about, that specific debt we all did, but specific debt, again, is that debt that they went out and specifically borrowed to build the asset. Other debt is the debt that the company already has, the long-term debt that they already have. So calculate the weighted average interest rate of the other outstanding debt, and then multiply it by the WAAE. What does the acronym stand for? WAAE. What does that stand for? You should.
Weighted average accumulated expenditures.
Good, Katone. Weighted average accumulated expenditures. Weighted average accumulated expenditures. And the calculation of weighted average accumulated expenditures is, they discussed it at the bottom of page 536, and at the top of page 538, you see the calculation of the weighted average accumulated expenditures. We're going to go into it. I'm going to give you some hints about the numerator and the denominator that we use. Do you see it says portion of year outstanding at the top of page 538? And there is a ratio. I'm going to give you helpful hints on what that ratio is. Okay. The only reason that this ratio, that the denominator in this ratio was because construction began on January 1st. How often does that happen? It doesn't. Okay. So we will look at you can see on page 539, the different ratios that are used to calculate the weighted average accumulated expenditures, okay? So again, we're gonna look at the calculations on that, but first let's go through the decision tree. So is there other outstanding debt? Is there specific debt? No. Is there other outstanding debt? Yes. Then you have to calculate the weighted average interest rate of that other outstanding debt. You're going to multiply that interest rate by the weighted average accumulated expenditures, the WAAE, the weighted average accumulated expenditures. And of course, we're going to calculate, principal, which is your weighted average accumulated expenditure, times the rate, which is going to be your weighted average interest rate of your other debt, times time. Don't forget the times time. I will give you helpful hints on that also. And then whatever interest you calculate is your capitalized interest from doing that step. If there is no specific debt and there is no other outstanding debt, meaning that the company is debt-free, which I don't know of very many companies that have no debt, then there is no capitalized interest. Okay. Now let's take a look at the left side of the decision tree. Is there specific debt? Yes. And again, I'm intentionally keeping the number crunching out right now so that you understand the process. So is there specific debt? Yes. That means that the company went out and borrowed money specifically to fund the building of this asset. So is there specific debt? Yes. The first question is the weighted average accumulated expenditure greater than the specific debt? Say I borrowed $1.8 million. If my weighted average accumulated expenditures is less than the weighted average accumulated expenditures, then I go to the no. Because if it's less than, then it's not greater than. So is the weighted average accumulated expenditure greater than the specific debt? If the answer is no, then you multiply the weighted average accumulated expenditure by the interest rate of the specific debt. Okay? Now, what if the weighted average accumulated expenditure, we're going to learn how to calculate this, the weighted average accumulated expenditure, but if the weighted average accumulated expenditure is greater than the specific debt, here we go with calculations. Step number one is multiply the amount of the specific debt by its interest rate. Not the weighted average interest rate of the other debt. We're not dealing with the other debt right now. We're only dealing with the specific debt. So multiply the amount of the specific debt by its interest rate. Okay? Then you're going to subtract the amount of the specific debt from the weighted average accumulated expenditures. So, for example, I borrowed $1.8 million of specific debt. What if my weighted average accumulated expenditures was $2 million? Well, I would multiply the $1.8 million by its interest rate, because that's the specific debt. Then the amount that the weighted average accumulated expenditure exceeds the specific debt, the $200,000 in the example that I gave you. So subtract the amount of the specific debt from the weighted average accumulated expenditure. So now I've got this $200,000. Step 3, calculate the weighted average interest rate of the other outstanding debt, just like we had to do on the right side when we had no specific debt. So we're going to have to calculate the weighted average interest rate of the other outstanding debt. Then multiply the $200,000, the result that I got from step 2, by the weighted average interest rate of the other debt, step 3. Then add step 1 and step 4 together. Remember, we calculated interest on the specific debt. Then we calculated interest on the amount that the weighted average accumulated expenditure exceeded the specific debt. And then we add the 2. And then, of course, we've got to take into consideration time after we have added the 2 together. You see, I've given you some hints about what the denominator is and what the numerator is. We'll be applying those hints as we are doing the calculation. Okay, so this is your overview of the steps that we have to take with calculating capitalized interest. So let's apply the decision tree and the information. Let's look at exercise 1025 on page 557. So exercise 1025 on page 557. So we've got, is everybody there? Page 557? So Thornton Industries began construction of a warehouse on July 1st of 2021. And the project was completed March 31st of 2022. Now I stop right there. I stop right there. And at the top of my page, I am going to put, what is my capitalization period? What is my capitalization period in the first year, in 2021? When did I start the project?
July.
July 1st, okay? So we started the project on July 1st. And the project wasn't completed until the next year, March 31st of 2022. So how many months did I have in 2021 of my capitalization period? In other words, what was my capitalization period in July of 2021? How many months?
6.
And you can count on your fingers because this was July 1st. What was it?
6.
Good, 6 months. July, because it was July 1st. So July, August, September, October, November, December. So in 2021, put at the top of the page that you're going to be working this problem on, you're going to see why I'm emphasizing this so much. It's going to help you with avoiding those OS moments in your number crunching. So in 2021, put 6 months. In 2022, what was my capitalization period?
3 months.
3 months, because it ended March 31st. So I had 3 months during 2022, January, February, and March. So then at the top of my page, I would put 2022-3 months. 3 months. This is going to keep you out of those OS moments. Now, does this company, it says no new loans were acquired. So that means that there was no specific debt. There was no specific debt on this project. So I'm trying to keep a simpler one at first. So we had no specific debt. Now, does Thornton have other outstanding debt? Yes. Right? They told us that they had a $2 million 8% note and an $8 million 4% note as their other outstanding debt. So look at your decision tree. Normally this decision tree is not available for in-class exams, but y'all got online exams, so this is going to be helpful. So going at the decision tree, is there specific debt?
No.
No. Is there other outstanding debt?
Yes.
Yes. So what do we need to do?
Calculate the weighted average interest rate of the other
We're
long-term
going to
debt.
have to, good, Katone, we're going to have to calculate the weighted average interest rate of this other outstanding debt and multiply it by the weighted average accumulated expenditures. So there's two things that we need to calculate. One, what is the weighted average interest rate of the other outstanding debt? And we're going to have to calculate the weighted average accumulated expenditures. So I'm going to share my screen. I'm going to go into Excel. And we're going to calculate the amount of interest that would be capitalized for 2021 and how much interest would be capitalized for 2022. All right, so I'm going to go into Excel. I don't know if you want to do it in Excel or by hand, depending on, I would get practice in both. So here I go. Share screen. And I'm going to get every. So let's calculate the weighted average accumulated expenditure. So let's calculate the weighted average accumulated expenditure. And the weighted average accumulated expenditure is how much time, as we know from percent complete, that companies hire contractors and you have to make payments during the construction period. Remember the billings that we had in Chapter 6, for self-construct, for when we were the contractors. So what was the date of our first expenditure?
July 1st.
July 1st of 2021. And our second one was September 30th of 2021. There is no September 31st. That's why I didn't recognize it as a date, because it doesn't exist. November 30th of 2021. And then our next one was in the ensuing year of 2022. So first we need to calculate what was capitalized interest for 2021. Now remember, at the top of the page, I'm going to insert some rows here because
I don't think we are seeing the screen you are seeing.
Oh, this happened last time and I don't know. So let me stop sharing the screen and go back into share screen. And are you seeing it now?
Yeah.
Okay, I don't know what happened. All right, so remember what I told you to put at the top of the page, so important. In 2021, we said that 6 months was my capitalization period in 2021. In 2022, my capitalization period was 3 months, okay? Put that at the top of the page. I even would bold it, on your, well, you're not going on your exam, but you got online exams, so never mind. All right, this I want to. All right, so now I've got the dates of the 3 expenditures that I have, and my expenditure for July 1st, 2021 was $400,000, and then $600,000 for November also. Okay. Now, look at the decision tree, and on the hint, notice that I put the number of months of the capitalization period in a year is the denominator for calculating weighted average accumulated expenditure, and it is the numerator for calculating interest times time. Okay, so when we get into calculating the interest, you're going to see that the 6 months will be used for the denominator for calculating weighted average accumulated expenditures, and it's going to be the numerator for calculating the time when we do principal times rate times time. Okay. So when was on July 1st, 2021, I made a payment to the contractor of $400,000. How long during the construction period was that $400,000 outstanding in 2021? Well, when did I pay the 400,000? What date did I pay the 400,000?
July 1st.
July 1st. How many months was the construction period still going on in the ensuing year in 2022? Yes. So how many months was this 400,000 outstanding during 2021? What is it?
6 months?
Good, 6 months. So it was outstanding 6 months. The 600,000, I paid it on September 30th. So how many months was it outstanding during 2021? Come on, let's go. This is easy.
3 months.
3 months, right? It was September 30th, so it'd be October, November, December. And just for calculation, I'm just going to put 6 and then understand that 6 months. This one was 3 months. And then on November 30th, how many months was it outstanding during 2021?
1.
1 month.
1 month. Okay. So this was amount, and this was number of months. All right. Now, what is my weighted average accumulated expenditures? What did I say that the number of months that it is, the number of months of the capitalization period during 2021 is 6 months. In the hint, what will I use that 6 months as? So
The denominator.
for what now? I'm sorry.
The denominator.
Good, the denominator. So my weighted average accumulated expenditures, I know that for the calculation of each of the 3, my denominator is going to be 6 months. The number of months that it was outstanding is the numerator. The numerator. Okay. So your numerator is the number of months that it is outstanding, and your denominator is the number of months it was outstanding during the capitalization period. Now I put the 6 and the 3 over here so that I could use it as a number in my calculations. So start calculating this if you're doing it by hand using your calculator. What is the weighted average accumulated expenditure for the year 2021? So I want y'all calculating it by hand or doing the formula if you're doing it in Excel. Does everybody understand how I calculated these numbers? I did it quickly, not that I'd care that you see my formulas, but I want you doing the calculations to make sure that you understand. My numerator, the number of months that it was actually outstanding based on the payment date during the construction period, and my construction period during 2021, which is 6, is my denominator. So if you did not get the 800,000, now's the time to ask the question. How did you get it? So they spent $1.6 million was the amount of actual cost paid during the year, but 800,000 is my weighted average accumulated expenditure, because this November one was only outstanding 1/6, if you understand weighted average. So my weighted average accumulated expenditure is 800,000. Now, looking at the decision tree, again, did this particular problem have specific debt?
No.
No. So did it have other outstanding debt? Yes. So we needed to calculate the weighted average accumulated expenditure, which is the 800,000. And I'm going to have to multiply it by the weighted average interest rate of the other debt. I didn't have any specific debt, so I want to calculate it by the weighted average interest rate of the other debt. So what other debt did they have? They had a $2 million note. They had a $2 million note that had an annual interest rate of 8%. They had an $8 million note that had an interest rate of 4%. Okay. So what would the annual interest rate be on these two notes? Now, they were outstanding for the whole year. It said that these notes, were outstanding previously. So equal the principal times the rate would be the annual interest on the note. So the total amount of interest that the company had outstanding was $10 million, the $2 million note and the $8 million note. And the amount of interest, of annual interest, is $480,000. So $480,000 is the amount of interest that they would pay. So my weighted average interest rate is the divide the total interest, let me put that, the total interest divided by the total debt. So calculate, and rounding, you can't do rounding. We need to have no rounding here, or round to 4 decimal places. So what is the weighted average interest rate? You can do it in your head on this one, not all of them, but on this one, at least I can, not showing off, but what is the weighted average interest rate?
.048.
Good, 4.8%. My total interest divided by the total debt. You know, in your finance classes and in business classes, you're going to need to calculate what is the weighted average interest rate of your debt. So 4.8%, I can convert this to a percent, but of course with the decimal places, this one ended up being 4.8%. So now I've calculated the weighted average interest rate of my other debt. Now the amount of my capitalized interest is the weighted average interest rate, the weighted average accumulated expenditures times the interest rate, and then I need to multiply it by time, right? We did the weighted average accumulated expenditures. This is your WAAE times the weighted average interest rate. Now I need to remember to multiply it by time. What is the denominator when we calculate interest? Interest is a what kind of rate?
Annual.
Annual, good. So if I'm trying to calculate monthly interest, then what is my denominator?
12.
12. Okay, so my denominator is 12. What did we say the numerator was? This is in the helpful hint that I have. I even have it twice in the 2 hints. Don't forget to multiply by time. The numerator is the number of months of the capitalization period, God bless you,
Thank you.
in that year. What is the number of months?
6.
6. So I will multiply the 38,400 times 6/12. So is equal to the amount of annual interest times the 6 divided by 12. And I know that's 1/2, but not all the problems are going to be that. So the amount of capitalized interest for 2021 is 19,000. Oh, that was supposed to be not a number. So for 2021 is $19,200. When this company pays their interest, say they just pay interest, you know, at the end of the year or whenever they pay interest, they would debit interest expense, say that they're actually paying their interest every year. Of course, they would credit cash. The amount of cash that they would have to credit is the 480,000. That's the total amount of interest that they have. I would debit what are they building? A warehouse. So I would debit warehouse for the amount of capitalized interest, and then interest expense would be for the difference. So my interest expense for the year would be $460,800. $19,200 is my capitalized interest. And then I would pay or credit interest payable, whatever is the way that they pay their interest, for the total amount of interest that they have for the entire year. Now this company, I know it's almost time for class, but I'd like to finish this problem very quickly. The amount of capitalized interest for what is capitalized, well, what is my weighted average accumulated expenditure for 2022. One of the things that you have to remember is to bring over your expenditures that you paid in 2021. How much did I pay in 2021? 800,000, 1.6 million. How much expenditures, total expenditures, did we pay in 2021?
1.6 million.
Good, 1.6 million. How much interest was capitalized in 2021? In other words, I am trying to look for what was the warehouse debited for in 2021. So every time they paid the 400,000, the 600,000, and the 600,000, they debited warehouse and credited cash, you know, for the amount that they're paying the contractor. So the amount of capitalized interest is the 19,200. Actually, I'm going to do this one because I don't want it to be bolded. So we need to bring over what was paid in 2021. How much did I pay in 2022? On January 30th of 2022, I paid $540,000. And I'm going to have to multiply these because I'm trying to calculate my weighted average accumulated expenditure. What is going to be the denominator for each one of these?
3.
3, exactly, 3. Because there were 3 months in 2022 of the capitalization period. Now the amounts for 2021, they were outstanding for the whole 3 months because they were carried over from 2021. So it's going to be equal to times that's my numerator. How many months was it outstanding? 3. Divided by my numerator, which is always my capitalization period. And we know 1.16. And I'm going to anchor this 3 months because we don't want to forget that is our numerator. The 19,200 was also outstanding for the whole 3 months. Now, how long was the January 30th payment outstanding?
2 out of the 3 months.
Good, 2 out of the 3 months. So it's going to be equal to the 540,000 times 2 divided by my capitalization period for the year. So times 2, and I think I did the B2 instead of, yep, that's the one I wanted as my numerator. 3, why did I do C39? Oh, well, it came out to the right amount. Okay. So the amount of my, and we will finish this, the amount of my weighted average accumulated expenditures for 2022 is 1,979,200. My capitalized interest, what am I going to do with that 1,979,200? What do I have to multiply it by?
The weighted average of the interest.
Good, the weighted average interest rate, which is the 4.8%. And we get 95001. And then I have to remember to multiply it by time. And on time, it's equal to the weighted average accumulated expenditure times time. Now on times time, what is my numerator?
3,
3. Why?
because that's the number of months in the capitalization
Good.
period.
That is the capitalization period. And I'm going to divide it by what? What is my denominator when we calculate interest? 12. So the amount of capitalized interest for 2022 is 23,750.40. Okay. Now we've got more work to do in chapter 10 before we get into chapter 11 on Thursday. I am going to upload. Actually, what I want you doing is I want you working exercise 1024. Work exercise 1024. It has both specific debt and other outstanding debt. Go into that left side of the decision tree so it gets a little more complicated, okay? Don't forget the hints. When you're calculating weighted average accumulated expenditure, your number of months is your denominator. When you're calculating interest, it is your numerator. That will keep you out of trouble. So work exercise 1024. There's a problem that I have written that I will upload into course content information that we will use on Thursday before we get into chapter 11. Okay? All righty. Peace out. And on Thursday, we're going to have a lot more coffee.
Do we have the quiz on Thursday?
On Thursday, you know, to save time, we're not going to do a quiz. But what I am going to do is I'm going to start back with pushing out those polling questions. Okay? So I'll start pushing back the polling questions. I don't want to do the quiz because I want to save time right now. What I may do is, yes, sorry, I didn't check email at all yesterday, given what was going on in the house. So sorry. Yes, I will check email. Okay, so I'll see y'all on Thursday. I'll upload a problem. Y'all practice 1024. Okay, and I'll put out announcement for about Thursday. Okay, I promise I'm back. All righty, talked between me being sick and my daughter-in-law. Oh Lord. All right, see y'all on Thursday.
Talk to you soon.
All righty, bye-bye. And Katone, give me a shout.
I will.
All right, bye-bye.
Take care.